Good afternoon. Welcome to today's Smart Investing Briefing. Well, today we have some interesting news. Actually, this week, some interesting news. The 10-year Treasury fell below 2% for the first time since 2016. What's going on here is what we're going to talk about today.
Yeah, and it closed today about 2.05%, so it has risen again back above that 2% level, but falling below that 2% level was quite surprising, and I'm going to keep saying it. I don't see how it can go lower, and I don't think bonds are a good investment. I think the risk to reward ratio is just not there for bonds because best case scenario, you maybe get a 3% return over the next 10 years if rates were to go down. Doesn't make much sense. Worst case scenario, rates go from 2% up to, let's say, 4% over the next 10 years. Now you've lost a lot of money, not doing well.
Yeah, and we're kind of a conundrum right here because a conundrum, I guess it's called, because of the fact that what we have like worldwide rates are very low. You got the 10-year bond at a negative 0.3. So here we are, the 10-year Treasury here, about 2%. But we're starting to see a little bit of signs of inflation, which is going to push rates up here. So that's what we're concerned about, is that when they're trying to compete with the world, we're going to be in a difficult situation because rates are going to have to rise because economies are doing well because we cut rates. And actually the overnight lending rate right now in the Fed is unchanged at 2.25 to 2.5 is what they did on Wednesday. But in July, I think this is down because everybody's pretty confident that right now they could be cut in July, but then again, maybe not.
Yeah, it's a big concern, and right now I think the market's trading on a lot of optimism. I think you have a lot of companies, a lot of growth companies that are doing well because right now debt's so cheap, and people think debt's going to remain cheap, which helps fuel those growth companies. Mm-hmm. But I still believe if we get that deal with China, if we get good employment numbers, one of those scenarios that comes in, I think that really raises the question, should we raise rates in July then? Because right now we have this potential for, I think, a big boom to the economy. If we can get China back to the table, get that deal passed through, I don't think we need to cut rates if that happens.
Yeah, and I agree with Chase, because actually what we're seeing is that a lot of CEOs and their estimates going forward, they are concerned about China. So they're just saying, no, we're going to hold off until this is done. If we get some type of China deal coming up in June, July here, we could see this whole thing change. And the problem is right now, if you have short-term rates, on the savings side, you're going to see that decline. This, I think, is also going to help the housing market a lot. I mean, because this is great for housing. Now, mortgage rates are going to go. So there's a lot of good things going on that could cause it to turn very quickly with a month, maybe two at the longest. So
yeah, I mean, that's why I agree with 9 out of the 10 voting members. You can see this is, I think, the first time that one member has actually voted against it, saying, I think we should cut rates.
Right.
And he wanted to cut at the June meeting, but obviously it didn't happen. And I think the market really anticipates that July cut. But again, where do rates go from here? I think there's nowhere to go but up from here. Yeah,
they're going to stay at this level, I think, for a while. Yeah. I think even when the cut happens, they're not going lower because the cut is already anticipated. That's why the 10-year Treasury went below 2% this past week. So.
And it's a good point to bring up. There is a difference between the Fed's fund rate or the overnight lending rate. That's actually what the Fed loans money out at versus the 10-year note. That's what you see all the time. That's based a lot more on supply and demand, where the Fed controls the front end of the lending curve or that short supply, and then the 10-year note, again, based on the market. So kind of different methodology on how these rates come about.
One thing I will say, try to give you something of clarity here, is that if you're buying a house, do quickly because you could see rates go back up in a month or two. So again, I recommend closing that house pretty soon. Be sure to tune in tomorrow morning to the Smart Investing Show on AM 760 KFMB. You can listen on your phone by podcast, by iTunes, all these different things you can do. So tune in. Have a great weekend. I hope you tune in tomorrow morning at 8 o'clock.